Here's something nobody in the business world will say out loud. The wealthiest people you've ever heard of are not actually in the business of making money. That sounds backwards, I know, especially in a video where I'm about to walk you from being flat broke to running a $500 million empire. But stick with me because once you understand what I'm about to show you, the entire game changes. The truly wealthy aren't chasing income, they're engineering ownership. They build invisible machines that quietly absorb businesses, cash, and assets, and then they sit on top of those machines and let them work forever. Income is what poor people optimize. Ownership is what rich people architect. And the gap between those two ideas is the difference between someone who works hard their whole life and dies with a paycheck and someone who builds a structure so durable it keeps producing wealth for grandchildren they'll never meet. I'm Henry, and on this channel, we don't just talk about getting rich. We talk about the blueprints behind staying rich, multiplying it, and protecting it from the people who'd love to take it from you. Today, I'm taking you through every single level of a holding company. We're starting at absolute zero, where you've got nothing but a phone and a half-formed idea, and we're climbing all the way to a $500 million empire with stacked subsidiaries, passive income flowing in every direction, and a legacy structure that runs without you ever touching it. We're not skipping the unglamorous parts. We're not pretending the legal scaffolding doesn't matter, because that unglamorous scaffolding is exactly the place where almost everyone quietly loses everything they built. So let's get into it. First, I need to destroy a misconception, because if you walk into this with the wrong idea in your head, nothing else I say will land correctly. A holding company is not just a fancy term for owning a few businesses. It's not a loophole. It's not some exotic toy that only hedge fund guys get to play with. A holding company is a parent entity, usually structured as an LLC or a corporation, and its only purpose is to own things. It doesn't sell anything. It has no customers walking through a door. It doesn't manage a crew or ship products. It owns. That's the whole job. Picture a real estate investor who never holds property in his own name. He tucks each building inside its own LLC, so trouble in one place can't bleed into the others. A holding company sits one floor above that. It's the entity that owns all of those LLCs at once. Here's why that single idea protects fortunes. Imagine you're running 4 different businesses, and one of them gets hit with a lawsuit. And let's be honest about America for a second. Suing people is practically a national pastime. With the right structure, that lawsuit stays locked inside the one business it came from. It cannot crawl upward into your holding company and devour everything else you own. It can't reach your other businesses, your savings, your home. The structure builds walls between your assets, sealed compartments like a ship designed so one flooded room doesn't sink the whole vessel. Now compare that to the average ambitious person who keeps everything in their own name, or worse, crams 5 completely different ventures into one overworked LLC. All it takes is a single bad contract, one angry former employee, one accident, and the entire thing they spent years building is suddenly sitting on a courtroom table for a stranger to pick apart. There's one more distinction I need you to lock into memory because it's the spine of everything that follows. There's the holding company, and there's the operating company. The operating company is where the actual work happens. It has staff, customers, vendors, daily chaos, and risk. The holding company sits calmly above all of it, holding the ownership, collecting the profits that flow up, and deciding where the money goes next. Your entire trajectory as the architect of this empire is to slowly climb out of the operating company and up into the holding company. Not overnight, not recklessly, but that's the direction. Hold on to that picture, because in a moment I'm going to show you the exact stage where most people accidentally sabotage themselves before they ever get off the ground. So let's talk about the level almost nobody respects. The level before anything. You'd be amazed how many people watch a few videos like this one and immediately try to set up some elaborate offshore adjacent structure with a trust on top and 3 shell subsidiaries underneath while their bank account has a balance of $41. They end up with 6 legal entities, 0 revenue, and an annual bill from their registered agent that's bigger than anything they've ever earned. Do not be that person. At this stage, you have exactly one mission, and it is not building a structure. It's building a business that actually makes money. Real cash in, real cash out, more coming in than leaving. That's it. We're talking from zero up to around $100,000 a year. You should have one operating entity, a single clean LLC, and that is completely correct. Simplicity is not a weakness here, it's the right move. But there are quiet habits you should be building at this stage that almost everyone ignores. The first is separating your personal money from your business money completely, and I don't mean someday when it feels important. I mean now, this week. A dedicated business bank account, a business card, and some kind of bookkeeping, even if it's just consistent accounting software. The reason this matters at such a small scale is that the habits you build now become the bones of the thing you scale later. I've watched people cross seven figures in revenue with their personal and business finances knotted together so badly that untangling it cost them a fortune in accountant hours and nearly created legal disasters. The second habit is understanding your tax options before the moment you actually need them. A basic LLC means you're paying self-employment tax on every single dollar of profit, while certain elections let you split your income in ways that can save serious money once your profit starts climbing. I'm not your accountant and this isn't tax advice, but you want to walk into that conversation already knowing the vocabulary instead of nodding along, confused. And the third habit is documenting everything, your client agreements, your operating agreement, your vendor terms, because a business built on handshakes and good vibes is a business you can never sell. From day one, you should be building something sellable, even if your plan is to keep it forever. Let me give you a person to follow through this whole journey. Picture a woman named Dana, 31 years old, who starts a mobile detailing business. Her first year, she pulls in around $65,000. She's the only employee working Saturdays, exhausted but genuinely profitable. One LLC, clean books, a simple operating agreement, and she's stashing 20% of every dollar that comes in. At this stage, Dana looks completely ordinary. She looks like 1,000 other small operators. But quietly, Dana is laying a foundation. And as you're going to see, the foundation is the part that decides everything. Now things start getting real. The model works, money's flowing, and you're either hiring or seriously thinking about it. This is the stretch from 100,000 to 1 million in revenue, and the most important shift here isn't legal or financial at all. It's psychological. You have to stop being the business and start owning the business. Those sound similar, but they're worlds apart. When you are the business, everything stops the second you stop. When you own the business, it keeps running whether you show up or not. The bridge between those two states is the exact spot where most ambitious people get stuck for years, or never cross at all. The way across is unglamorous, systems and people. Every task that repeats needs to be written down, handed off, or automated because your most valuable activity is no longer doing the work. It's thinking and deciding. The faster you pull yourself out of the daily grind, the faster the whole thing can grow. And structurally, this is where a smart move starts to make sense. If your business is throwing off consistent profit, you might form a separate management company, an LLC that provides management services to your operating business and charges it a fee. Your operating business pays that fee as a legitimate expense. Why bother? Because it begins to peel you away from the business as a person and reposition you as an owner of an asset. It creates a paper trail showing management as a distinct function, and it quietly starts forming the skeleton of the holding structure you'll build later. This is also the moment to take insurance seriously, general liability, professional coverage if it fits your work, an umbrella policy on top. It's boring, and boring is exactly what stands between a lawsuit that ends you and a lawsuit where you write a check and move on with your day. By year 3, Dana's detailing operation is doing $400,000 a year. She's got 5 employees, a route manager, and she barely picks up a towel herself anymore. Her accountant set up a tax election that's saving her thousands annually, and she's launched a second business, a paint protection and ceramic coating service for dealerships, under its own separate LLC, 2 businesses, 2 entities. And Dana's started asking herself a question that keeps her up at night. Should there be something sitting above all of this, holding it together? And the answer to that question is exactly where we go next. Once you cross $1 million in revenue, you have genuine assets to defend. You probably have more than one business, Real employees with all the legal exposure they bring, signed contracts, maybe equipment, maybe intellectual property, maybe property. A single layer of LLCs is no longer enough protection. It's a house of cards waiting for a strong breeze. So here's what a real holding structure starts to look like. At the very top sits your holding company, usually formed in a state known for strong ownership protections, structured so it can't easily be reached. This entity holds nothing but equity in your other companies. It signs no contracts, it hires no one. It simply owns. Beneath it sit your operating companies, each one its own sealed compartment. You might add a separate entity to hold any real estate because property carries its own special flavor of liability. You might even create an entity that owns your trademarks and brand assets and then licenses them down to the businesses that use them, which can deliver both protection and tax advantages. Here's how the money moves through that machine. The operating companies generate revenue, cover their expenses, and then send their profits upward as distributions to the holding company. The holding company becomes the brain. It decides where that capital goes next, into a new business, into property, into investments, or into your pocket. This architecture does three powerful things at once. It isolates risk, so a disaster in one business can't reach the others. It moves money efficiently, since profits flowing from a subsidiary up to a parent generally aren't taxed at the moment of transfer, letting capital travel inside your empire without bleeding out to taxes. And it creates clarity, because a clean ownership chart makes it dramatically easier to bring in a partner, sell off one piece, or eventually attract serious outside money. But here's where I have to warn you, because this is where people destroy their own protection. Some build the structure wrong, leaving their personal name plastered directly on every entity with nothing separating anything. Others build it perfectly on paper and then operate it carelessly, mixing money between companies, paying for personal vacations out of the business account, never documenting a single real decision. When a court is deciding whether to ignore your entire structure and come after you personally, they look at one thing. Did you actually treat these as real, separate businesses? If you didn't, the paperwork won't save you. Paper never saved anyone. Discipline does. So Dana finally forms her holding company, gives it a name that sounds appropriately serious, and places her two operating businesses and her real estate entity neatly beneath it. A real attorney reviews every piece. Dana isn't wealthy yet, but her structure is now built to hold real wealth when it arrives. And that arrival is closer than she thinks. When you cross $10 million, you've entered territory most people never reach in their entire lives. And here's the uncomfortable truth waiting for you at the door. The exact skills that carried you here will not carry you forward. Getting a business to 10 million is an execution game, all about systems, hiring, marketing, and grinding operations. But climbing from 10 million toward 50 million is a completely different sport. It becomes a capital allocation game. It's about deciding where to place your money and your attention so that it compounds. Capital allocation means staring at a single dollar and asking, where will this dollar earn the most? Should it go back into the business you already own? Should it buy a competitor while the price is right? Should it fund a business in a neighboring industry that makes the whole empire stronger? Or, and people forget this is even allowed, should it just sit patiently in cash while you wait for the right opportunity to appear? Knowing when to do nothing is one of the most underrated skills in all of wealth building. This is also where acquisition becomes your superpower. The smartest holding companies at this level don't grow by building everything from scratch. They grow by buying businesses that already work. A solid business throwing off a couple million in earnings might sell for a multiple of that number, and if your holding company can buy it, plug it into your existing systems, trim the duplicated overhead, and run it better than the previous owner did, you've just manufactured an enormous amount of value out of thin air. This is the quiet engine behind some of the most respected holding companies on earth, the ones that buy good businesses, run them well, and simply never sell. Your internal team starts to matter immensely now. You need real financial leadership who can track money across multiple entities and model out acquisitions. You need lawyers on retainer for deal structure, not just for fires. And you need advisors who've already operated above your level and can tell you the truth when you're about to make a mistake. And there's a trap lurking here that swallows founders whole. At 10 million, the ego shows up. The house, the cars, the lifestyle that screams success before the structure underneath is genuinely durable. Then a downturn hits, or a major client walks, and suddenly that lifestyle becomes an anchor dragging everything down. The whole magic of the holding company is compounding, and compounding only works if the capital actually stays inside the machine and keeps growing. So live beneath your structure, take out only what the empire can comfortably produce, and let the rest keep multiplying. That single discipline is what separates people who have one impressive decade from people who build something that outlives them. And speaking of building something that outlives you, the next level is where this stops being a business and starts becoming something far bigger. At 50 million, you're operating in a completely different atmosphere. Whether you ever say the words out loud or not, your holding company now functions like a private equity firm. You're acquiring companies, managing a portfolio, allocating capital across multiple businesses, and steering a lot of human beings. The governance that was optional before is now mandatory. Each subsidiary should have its own board with genuine outside voices providing real oversight, not just friends nodding politely. Those boards should meet regularly, and decisions should be documented in writing. Your holding company needs a written set of rules about what it will and won't buy, the industries you focus on, the size of deals you'll consider, the minimums you require, because without those rules, you'll burn months chasing deals that were never right for you. You need a real pipeline, evaluating multiple targets every quarter, knowing most will be wrong, a few worth examining closely, and maybe one or two a year actually worth closing. This is also where you should start thinking about permanent capital, and this is a genuine structural advantage most people never even hear about. Private equity firms operate on a clock. They raise money, deploy it, and are forced to sell their businesses within a fixed window, sometimes selling great companies simply because the timer ran out. A holding company built on permanent capital has no timer. It can hold a great business forever, optimizing for decades of value instead of a quick exit. At this level, the holding company itself develops a reputation in the market. Sellers recognize your name. Brokers bring deals to you first. The best operators want to work for you because they know you'll be a responsible owner. That reputation takes years to earn and is nearly impossible for a competitor to copy, which makes it one of the most durable advantages you can possess. But even reputation isn't the final boss. Because at the very top, the threats stop being external and become internal. At 200 million and beyond, the holding company is no longer just a legal structure. It's practically a civilization. It has a culture. It has systems older than its current managers. It has relationships compounding on themselves and a reputation that delivers the best opportunities before they ever reach the open market. And here the entire conversation shifts from building to preserving and compounding. There are three silent killers at this scale, and they're all internal. The first is succession, the question of who runs this when you're gone. Most founders dodge this question because it forces them to confront their own mortality and admit they aren't truly irreplaceable. But the greatest empires in history are precisely the ones that outlived their founders. Building a succession plan isn't weakness, it's the final masterpiece of a real architect. The second killer is dilution, which happens when the empire starts adding complexity faster than it adds value, when not every acquisition is wise and not every new venture makes sense. The discipline to say no, to walk away from a beautiful-looking deal that simply doesn't belong, becomes more important the bigger you get, not less. The third killer is drift, the slow erosion of the principles that made the company great in the first place. At this size, you've got businesses run by people who never once worked beside you, layers of management standing between your vision and the daily reality, and drift becomes almost inevitable unless you constantly, deliberately reinforce what you stand for. This is also where the final architecture appears. A trust often comes to own the holding company itself, pulling those assets out of your personal estate, providing for generations you'll never meet, and ensuring everything continues no matter what happens to you. A charitable arm frequently becomes part of the empire too, both because values matter and because it's woven intelligently into the estate planning. And perhaps most importantly, the great ones write down their philosophy, a living document that explains why this empire exists, what principles govern every single decision, and what it should look like 50 years from now. The legendary holding companies have written letters and operating principles passed down for decades. These aren't marketing brochures, they're the soul of the enterprise, the thing that survives long after any single person, including the founder, has left the room. So let me bring this all the way back around. We started with a strange idea that the goal was never really the money, and now you've watched that idea prove itself across 5 levels and $500 million of value. From Dana scrubbing cars in her first year to a $500 million machine with subsidiaries running themselves, the underlying game never changed. Build structures that protect you, compound for you, and outlast you. The holding company isn't the destination, it's the vehicle. And like any vehicle, it only takes you somewhere if you understand how to drive it, maintain it, and point it in the right direction. Most people will never get past that very first level. And not because they lack brains or hunger, it's because they underestimate the boring foundational work, the clean books, the operating agreements, the discipline at the exact moment when none of it feels urgent. And urgency is a terrible teacher. It only arrives after the lawsuit, after the partner falls out, after the buyer walks away because your records were a disaster. The people who build empires are the ones who treat every stage, even stage 0, as if the structure already mattered, because it always did. So start with the right foundation, build the right structure, operate it with discipline, allocate your capital with real intention, and protect what you build at every single step. That's not just how you climb from nothing to 500 million. That's how you build something that refuses to die. If even one idea in here shifted how you see this game, send it to someone out there quietly building something of their own. And if you want me to go deep on any single level, the acquisition playbook, the entity structures, the capital allocation frameworks, tell me in the comments and I'll build the next blueprint around what you ask for. I'm Henry, and I'll see you in the next one. Let's keep building.